Welcome back to Investing Talk Podcast.
Today we're looking at TeraWulf.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Let's do it.
Okay, so for a long time, the investment community, they sort of viewed TeraWulf through this really narrow lens of just traditional digital asset mining.
Just another crypto miner, basically.
Yeah, exactly. But that entire narrative has been, it's been completely ripped up and rewritten in the last year.
Yeah.
The recent explosive momentum, it's not really about the price of Bitcoin. It's almost entirely due to this rapid strategic pivot toward building infrastructure for high-performance computing, HPC, and, critically, for AI compute.
So they're trying to become a pure infrastructure play for the AI boom.
That's the definition of it. They're trying to ride the biggest secular growth trend in the world.
And when you look at the Q3 2025 numbers, that pivot seems to be paying off, dramatically on the top line.
Oh, absolutely.
The company posted an astonishing 87% year-over-year revenue growth. We are not talking about, steady incremental improvement here. This is explosive acceleration.
It is. It's driven by new capacity coming online and just being immediately monetized by this AI wave. But for me, the most important figure is the gross margin.
Okay.
Especially in such a capital-intensive sector, their gross margins hit 50.2%. Now, if you look back at the old commodity digital asset mining business, margins were often, razor thin.
Right.
Volatile.
Completely tied to the price of the asset.
Exactly. Hitting 50% gross margin signals that the services they're providing now, this high-density data center capacity, it's incredibly valuable. And it's profitable at the operational level.
That's a really essential distinction. It shows they're moving up the value chain. They aren't just selling a commodity, they're selling premium infrastructure. But is this growth sustainable, or is this just a one-time pop?
Well, the consensus among analysts is that the acceleration is not only sustainable, but it's actually going to intensify.
Really?
Yeah. The projection for 2026 revenue is sitting around $431.2 million.
Wow.
If they hit that, it represents an expected growth rate of 118.4% year over year. Investors are betting that TeraWulf is transforming itself from a relatively small mining operator into a critical infrastructure player almost overnight.
And that's what's generating all the excitement.
That's the intense market excitement, yeah.
But that kind of massive systemic shift, it doesn't happen in a vacuum.
Yeah.
It needs external capital, huge resources, and I think crucially, serious institutional validation.
Right. And this is where their competitive advantages, their moat, really start to form.
Okay.
Absolutely. The anchor of their whole position is the relationship they forged with Google.
The Google deal.
This is far more than just a typical customer contract. It's a deep strategic partnership. It includes a massive $1.8 billion lease backstop, an equity investment, and a warrant agreement.
Okay, let's unpack that $1.8 billion deal. It sounds huge, but what are the actual mechanisms that make it so powerful for TeraWulf? Let's start with the warrant agreement. What is that?
So the warrant agreement is key because it aligns incentives. Essentially, Google gets the right, but not the obligation, to purchase a significant amount of the company's equity at a set price in the future.
So it ensures Google is invested in their long-term success.
Exactly. They're not just a customer. They're a strategic partner who wants to see that stock price go up. It's an explicit endorsement of their future value.
Okay, so Google isn't just renting space. They're literally betting on the company to succeed. That gives the market a ton of confidence. And then there's the $1.8 billion lease backstop. That sounds like guaranteed revenue.
That's exactly what it is. The backstop provides a foundational floor for their revenue. It offers a stability and a predictability that is just incredibly rare for a growth company in this space.
And I imagine that de-risks their balance sheet massively.
Hugely. When they go to raise more capital for expansion, they can essentially collateralize that Google contract. It lowers their cost of capital, and it validates their entire strategy.
Right. That validation is hard to quantify, but easy to appreciate. It tells you their Lake Mariner facility, their whole design, it meets the standards of the world's biggest cloud provider.
Exactly. And they haven't put all their eggs in the Google basket either. They also secured up to a 51% ownership interest in a future 200-megawatt HPC project with a company called FluidStack.
So they're building out capacity through multiple avenues.
Correct. Partnership, ownership, direct development. But the most fascinating strategic advantage they have, I think, relates to their tech stack.
Flexibility, you mean?
Exactly. Because they started as a digital asset miner, their infrastructure can efficiently support both the original power-intensive mining operations and the super demanding high-density AI workloads.
So they can pivot on a dime.
Pretty much. This dual capability allows them to capture growth across two disruptive markets. If Bitcoin pricing dips, they can repurpose space for AI. If AI compute slows, they can shift back to mining.
That's a brilliant way to future-proof their operations.
It's a powerful diversification that leverages the same physical assets.
So looking at the bull case, with $90 million in cash and reserves as of Q2 and these massive partnerships, it looks like they have the financial runway to execute.
They absolutely have the runway, and the growth trajectory is undeniable. However,
Here it comes.
this brings us squarely to the second, more complicated side of the investment thesis, that aggressive expansion is expensive.
Extremely.
And when we look at their financials, you have to ask, how is this scale being funded and at what cost to the bottom line?
That's the core tension here. You can't get 100% plus growth rates without spending aggressively. So let's talk about the bear case. Let's start with profitability.
Okay. Despite the stellar top-line growth, the company is still deep in the red. They're reporting a substantial negative net profit margin. It's running at negative 336.53%.
Wow. So for every dollar of revenue, they spent over $3 to get it.
Once you factor in financing, depreciation, all the overhead, yes. This strategy is explicitly prioritizing massive scale over any near-term earnings.
And the market saw this in their Q3 performance, where they had an EPS miss, even though revenue was way up. It's the classic growth versus profitability dilemma.
Magnified, yeah. And the key question for investors is when, or if, that operational scale will eventually convert into positive net income. Because until then, this build-out has resulted in some serious financial leverage.
Let's address the debt profile directly. How leveraged are they?
They have substantial debt. It's highlighted by a very high debt-to-equity ratio of 428.6%.
So over 4 times more debt than equity.
Right. They're largely financing this push through debt, including a recently announced $3.2 billion green notes offering.
That's a huge number. What are green notes?
It's a type of bond where the money has to be used for projects with environmental benefits. In this case, building energy-efficient data centers that use mostly green power, which is one of their advantages.
So the interest rate might be a little better.
It might be because of the ESG component, but it is still debt. And relying so heavily on leverage leaves very, very little margin for error. If AI demand slows even a little, or if interest rates go up, their financing costs could become crippling.
So the high leverage and the negative profitability, that really defines the downside risk here. The bull case requires perfect execution.
Perfect execution in a sector that is inherently challenging. The execution risk is multi-layered.
What are the biggest hurdles?
Well, first, managing two growth verticals, crypto and AI, is complex. Different skills, different hardware. Second, you have all the normal data center risks. Cybersecurity, power availability, and the massive logistical risk tied to developing huge projects like the Lake Mariner expansion.
Data center construction is famous for delays and cost overruns.
Precisely. Any significant delay hits that already leveraged balance sheet hard, and it could require painful debt restructuring or, dilutive equity raises.
And for any potential investor, they have to know about the stock's volatility. The beta is extremely high at 4.31.
That beta is a giant flashing red light. It indicates extreme volatility. It means if the S&P 500 moves 1%, this stock tends to move over 4%. It really trades on sentiment and news, not just fundamentals.
The 52-week range of $2.06 to $17.05 really says it all.
It perfectly encapsulates this dynamic. This is not a position you just buy and forget about.
Okay, let's move on to the near-term drivers, the catalyst that could cause the next major move. What are investors watching for?
The nearest major event is the Q4 2025 earnings release. We expect that late January, maybe early February 2026, this will be the first quarter where the ramping HPC revenues, the Google money, are meaningfully reflected.
And what will people be scrutinizing?
Two critical things. First, proof that the new HPC lease revenues are slowing in as expected. And second, any movement towards operational leverage. Are they finally starting to manage those huge fixed costs?
We also need to watch institutional activity, right? Big money moving in or out.
Absolutely. Two key windows to watch. First is the December 15th ETF rebalancing. That can cause short-term fluctuations. But the more important event will be the February 2026 13F disclosures.
And remind our listeners what 13Fs are.
They're quarterly reports that big institutional managers have to file, disclosing what stocks they own. The February 13F will reveal which major funds have been buying shares. If you see significant blue-chip institutions on those filings, it provides more validation for the bull case.
And technically, the chart looks pretty bullish right now.
It does. The recent price action confirms that the momentum is still there, despite the risks. We saw that big surge, almost 11%, on November 20th before it consolidated.
So it's holding key levels.
It's trading above its key moving averages, which confirms a bullish uptrend. Traders are watching support around that $11 to $12 range. A break below that could signal a reversal, but for now, the market seems to be accumulating shares.
And finally, with a stock this dynamic, you can't ignore the speculative buzz. We should stress these are totally unconfirmed rumors.
Absolutely. Treat this with extreme caution. The chatter centers on three things. First, ongoing M&A talk, a potential acquisition by a major tech firm looking to buy, not build, green HPC infrastructure.
Plausible.
Second, unconfirmed reports of international expansion, maybe into Europe or Asia. And third, speculation about new partnerships with other cloud providers beyond Google. But again, these are just rumors. The focus has to remain on their actual execution.
So to synthesize everything, TeraWulf is really the epitome of a high-risk, high-reward opportunity. It's driven by these incredibly powerful tailwinds in AI and HPC.
That's the perfect summary. They have all the ingredients. The partnerships, the amazing revenue growth, the premium margins on the new business. They have a spot in the hottest sector in tech. But the high financial leverage and the negative profitability create a very real, non-trivial downside risk if execution falters.
Right.
If those data center builds get delayed, or if the cost of debt keeps climbing, things could get difficult fast.
So given that impressive top-line growth and the massive debt load, the critical question for the next year seems to be this. Can management definitively prove that the huge operational scale they've gained is actually sustainable, and that it leads to free cash flow generation, not just continued expansion fueled by more losses?
Exactly. That transition from growth at any cost to profitable scale is what will make or break this entire investment thesis.
A powerful point to think about. If you found this discussion valuable, be sure to subscribe to Investing Talk Podcast for more analysis.